Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to go ahead and review the overall markets and basically go over the primary analysis of what's going on in the European and the United States and the whole global market scene as a whole. Right now I'm inside of a Starbucks right now, but it's actually empty, so the place is kind of quiet compared to what you would usually expect. So again, just trying to squeeze in the time frame where not so loud, so I can go ahead and record this quick video for all of you. First of all, the dollar index has had a pretty substantial pullback in today's trading action, and as you guys can go ahead and see, at around 2 p.m. it has had a humongous crash, and that crash has actually happened just a couple minutes ago. The dollar index is having a rapid pullback, and let me go ahead and pull up the Euro-US dollar chart. The Euro-US dollar chart has just ripped out from around 2 p.m. onwards, and has just continued to do so. So the main point I want to bring out here is that I was anticipating a pullback at around the 50-day moving average. You guys didn't really get to see that much because, again, I made a video the other day and there was a lot of talking and I just didn't feel like uploading it. But again, we hit the 50-day moving average. The Euro-US dollar had a hard time penetrating that, and it had had a significant pullback for a while. But then after a while, the Euro-US dollar decided just to go back up and retest that 50-day moving average, by which it has already pulled back from that 50-day moving average. Again, I do anticipate the Euro-US dollar to eventually break that 50-day moving average. After all, the European bailout fund has been increased, and the German and the French Chancellor has basically issued out more bailout funds for the weaker European periphery states. Now, in my honest opinion, these European periphery states shouldn't be bailed out, and they should be allowed to just default. And the longer-term implications of a default would be much better than to continue to expand the fund dedicated towards trying to keep them afloat for just a little longer before they have to bail them out again. But for right now, the market interprets that as a positive sign for the euro, and therefore confidence is being restored back in the euro. Therefore, the US dollar would have to decline in proportion to the European currency, which is basically the euro. So again, the euro should have a pretty strong rally coming out of this. As you guys can go in and see, I'll draw in a quick trend line right here. And you're already seeing a breakout of a quick channel right above the 1.34 area. So again, I do anticipate there to be a continued resurgence for the euro that would basically allow it to break out of the 50-day moving average based on fundamental factors right here. Let's go back and review the Dow Jones Industrial Average. Dow Jones Industrial Average has had a significant pullback, but it basically was able to reclaim some of its gains, and I was anticipating this pullback mainly because of this double topping pattern right here at around 1,600. So again, we basically got out of the 1,000. We're basically, channeling right in the 11,600 area for Dow Jones, excuse me, and basically I anticipate this area to eventually be broken as soon as we get above that 100-day moving average. So once we break above that 100-day moving average, I anticipate longer-term upside for the stock market. And the main reason is, again, we're at a point where we're restoring confidence into the stock market by basically bailing out European countries. Now, while European countries may not seem important to you as investors, and it certainly isn't important to me as well, but basically what's happening is that the main reason why it's so important is that without a bailout, you're basically causing the European currency to weaken, and therefore the US dollar is strengthening. And when you have the US dollar strengthen, that's usually negative for the stock market. And if the US dollar weakens, that's basically very beneficial. Notice how you have this humongous pullback in the US dollar, and on the same exact day, on the same exact note, you're seeing such a humongous rally on the Dow Jones component. That's to be expected because the stock indexes and the US dollar index generally move in an inverse pattern towards one another. So again, my overall outlook is, so as long as the dollar index continues lower, we should see continued momentum for the Dow Jones and Industrial Average. The main reason why that's happening is because the euro is being bailed out, or the European states are being bailed out, which is causing the euro to strengthen to the US dollar. Therefore, the US dollar is going up, and therefore, well, actually, the US dollar is going down, and therefore, stocks are getting a boost based on inflationary pressures caused by the dollar index. So again, the main point here is that the Dow Jones and the S&P 500 index should be moving in a mirror pattern towards one another, and they should continue going higher. Obviously, the S&P 500 should be the most to benefit, mainly because of the S&P 500 is diversified in companies from smaller companies that should appreciate a little faster than the Dow Jones Industrial Average. Okay, so let's get past the currencies and the stock indexes and move on to the gold market. Gold is not really responding much to whatever's happening in the European markets, and the same thing for silver. As you guys can go in and see, in fact, gold has just pulled back, and The main reason why gold is pulling back based upon a European bailout is because gold was bought up on the anticipation that there was a potential European default that was about to happen in the last couple weeks and months, in fact. So for quite a while, gold was being bid up for quite a bit, and it even went up to around 1,900 before it hit its double top and pulled back. The main reason why it's not going up any further is because there's no stimulating factor to cause gold to go higher. So again, I am very neutral on gold. I don't want to be a buyer here, and I certainly don't want to short it just because the European countries have just been bailed out. The only thing I anticipate coming out of gold right now is that it should be trading in a range-based manner, and of course, I do anticipate a longer-term downtrend. So again, as you guys can see, we have a short-term downtrend in play. We got a weekly negative triangle chart, and then we have a positive weekly triangle chart. But with the news that just came out of the European Union, as just recently, again, there's no real reason to be buying gold right now, especially because gold was being bought up on European fears. Right now, those fears have been subsided, therefore I wouldn't be a buyer of gold. The same thing can be said for silver as well. Silver is also a hedge against fear and anxiety in the marketplace, but it's also a speculative play of just on the demand aspects and the supply and demand aspects of silver itself. Right now, I wouldn't be a huge buyer of silver, and you know, silver has had a significant decline. I mean, it's gone all the way down to around 25 before. I'm not too bullish on silver, and I'm not too bearish on silver. I'm thinking that it would just trade in a range-based manner. Again, I don't really have much of a pulse on it. Right now, I think that silver could continue to go a little lower based upon the European bailouts, and there's no real fundamental reason to be buying silver right now. So again, I'm just basically neutral to bearish on silver, and the same can be said for gold as well. Okay, moving on, let's go ahead and review the crude oil market. Crude oil has had a humongous rally today. It's gone all the way back up to 88.55. It is touching that 100-day moving average, so again, I don't think it'll break above that 100-day moving average quite so simply, but again, the main point here is that the crude oil market is responding very positively to the dollar depreciation. So right here you're seeing the dollar depreciate, and right here you're seeing the crude oil market continue to go up rapidly. So again, I do anticipate a longer-term uptrend for crude oil, and I wouldn't be shorting crude oil yet. But again, the main reason why this is all happening is because of European bailouts. European bailouts result in a stronger euro. Stronger euro means a weaker dollar, and a weaker dollar means stronger commodities and stock indexes. That's just the way the markets work. Moving on, volatility index is pulling back from its recent highs, and again, it's continuing its downward trend, and I think this downtrend will continue. And let's go ahead and plug in the trade triangles to prove that point right here. We have a negative weekly triangle. We did have a short-term positive triangle, but we have a short-term daily and a negative weekly. So this negative weekly triangle should continue to persist. Obviously, the volatility index is in a downtrend because the stock indexes are performing so well as of this moment. So, okay, so the Dow Jones Industrial Average is going up, and the volatility index is going down. Nothing new here. However, I anticipate the volatility index to continue going lower. Therefore, I would be bearish on the volatility index, mainly because European issues have subsided for the meantime. Whenever that happens, you do see a significant decline in the volatility index, meaning that there are great shorting opportunities on the volatility index, which just means, you know, more profits to be made. If you go ahead and look back 2 years or so, you can see that every single time the European economy has had issues, it has had a humongous rally. But once it got its bailout funds, you see a humongous collapse in the volatility index. Right now, I'm looking at a level where it traded at $500, and that was the peak of European fear, anxieties, which happened just basically last year. And ever since then, after the bailouts occurred, the volatility index has already declined by over 95%. So again, if I were to trade this market, I'd basically short this market and make much more profit than trying to hold on to a volatility index trade that could basically work against me and result in a 95 to 99% depreciation. Of course, if you're shorting the volatility index, you would make a humongous return on investment as long as you keep on borrowing funds to continue the margin, and obviously you understand the rest of what I'm implying. So again, volatility index is not a good time to be buying the volatility index. I'd be definitely short. And overall, the market outlook for the stock indexes are positive. The Euro-US dollar should continue to strengthen to the US dollar. The US dollar downtrend should continue. That does it for my market analysis and my market review for today. If you guys have any questions, be sure to go ahead and leave a comment right below this video. And thank you all for subscribing to my YouTube channel. If you guys are interested in this stuff, please be sure to go ahead and subscribe. Thanks a bunch, and I'll see you all next time.